Well, thanks everybody attending the session. So today my topic is how to capture the AI supply chain opportunities through a CSOP APAC Select Index ETF. So since the host just introduced, I'm the head of fixed income. So what drove a head of fixed income portfolio manager to talk about equities? The answer is quite straightforward. It's the AI bottleneck actually serving as the APAC equity tailwinds. And if you look back the first half of this year, although majority of the global central banks, they are relatively in a hawkish mode on the back of the inflation concern, the global equity markets, they still stay rallying. But this time, the reason is quite different. Instead of a rate cut expectation or a so-called price multiple expansion, if you look at the chart on the right-hand side, the earnings outlook or the earnings prospects are the real driver. And these drivers are also expected to be the main driver for the rest of the year. So on the back of this earnings-driven market, as you may be already familiar with, the AI trade or AI upstream trade has been in focus. This not only driving the US market, but also driving the global market, including the Asia-Pacific market. So to further decompose this value chain currently benefiting from this AI boom, we can start in reverse order from the bottom, the so-called AI apps that we are most familiar with, such as the ChatGPT, Gemini, Cloud, or the Copilot. But to support these kind of apps, we also need the infrastructure in places, such as the network facilities, such as the data centers, including the Amazon Web Services, including the Microsoft, and also the Google Cloud. And what are actually behind is competition of the calculation or computing power. This is mainly provided by those cheap designers like the NVIDIA, like the Intel, and also the AMD. And in the meantime, the storage, the memory chips, those providers are also key, such as the SK Hynix. For example, they just listed in the US as an ADR vehicle and also surged at 15-17%. And also like the Samsung and also the Micron in the US. And in addition, we also need the manufacturers to make sure the whole manufacturing process of the key chips and also to ensure the smooth connection of the key parts on the main board. So that's why we need the TSMC and also the names like SMIC. And at the end, or on the top, to support all this calculation power value chain, we also need the electricity, such as like the energy production and also the power generation, as well as the power supply. So to make it even simpler, in fact, this chart is developed by our company's chief economist to put the AI value chain into a perspective. So obviously, as shown in the middle, the GPU, the CPU, and also the high performance, the memory chips, they are acting as brain. And AI energy can be treated as food or oil. And AI's digital infrastructure and also the physical space, like the so-called enterprise solid-state disk, and also data centers, can be treated as house. And additionally, we also need the transportation, like the communications through the optical module, and also the clothes, such as the AI supporting hardware materials. So in short, a Chinese term can describe these 5 dimensions, which are the 衣食住行 and now. So instead of benefiting evenly or equally from the current AI boom, in fact, the whole AI value chain has highly been fragmented. This is because the profit are actually shifting from the cloud providers to the semicon sector. This is also not surprising because the tech giants for now are still mainly refinancing their investments through their operating cash flow, which means the cloud providers, they're spending money, but their upstream industry, like the chip producers, designers, they are receiving money. They can see more earnings, like such as the NVIDIA, such as Samsung, and also the SK Hynix. And also different from the previous smartphone era, which used to mainly benefit, let's say, the apps, advertising, or even the mobile brand. But this round, because the AI is still in the infrastructure build-out phase, with the hardware still being a key bottleneck. So it justifies an inverse triangle, as shown on the right-hand side, with the semicon accounting for the largest revenue share, followed by the cloud computing and the apps for now. And this page actually is originally from Goldman. These highlight these supply-demand dynamics of the key AI upstream components and materials. It just echoes that the bottleneck have indeed shifted from the downstream to the upstream. For example, the memory chips, whether it's in the form of DRAM or in the form of NAND, they have seen a surge in terms of their underlying prices year to date because of these very tight supply-demand dynamics. So to be honest, it's very time-consuming to explain the first columns, the usage, the terms of each key components. But it's relatively easy for investors to understand as long as there is the supply is falls short of demand, then the relevant key upstream components, they will expect it to see a price surge in the near term. And here it shows as orange colors as shown on the right-hand side. And in the interest of time, because we only have 20, 30 minutes, we will just highlight the memory chips for now, because it sits in the midstream device layer of the semicon chain, and also accounts roughly 25 to 35% of the global semicon market. And as you may know, the primary function of the memory chip is to handle the temporary data storage and the long-term data retention. It's just like how the memory chips support our video games and PC games when we play such games. And in short, this kind of data storage can also be treated as the oil of the AI ecosystem. So what's happening in the memory chip industry? So in simple, the current memory chip surge is simply because of the very, very tight supply environment. For example, the inventory cycle of these DRAM chips has just dropped to only 2 to 3 weeks. But just back to 2 or 3 years ago, these inventory cycles were still 10 to 31 weeks. But the reason behind is quite straightforward, because we are still in an AI demand-driven super cycle. And in addition, we also see the upgrades of the data centers and stronger than expected sales of the personal devices. And all of these factors, they all contribute to the further price surge of these underlying memory chips. And this, in turn, directly benefit industry leaders like the Samsung and SK Hynix, because they have more capacity to those higher margin, high performance memory chips. And this in turn also leading to a broad-based price increases for their underlying chips products and also their stock prices. And even on a forward-looking basis, we think at least in this year and next year, this tight supply demand and then this gap is unlikely to be resolved in the near term. And also the so-called high investment requirements in the advanced processing nodes will create a very strong and durable barriers for the other competitors to enter this industry. That's why the leaders like Samsung and SK Hynix, their edge will expect it to continue at least in the short term. And also, if we do believe this would happen, the demand will continue to driven their price and their volume, then we do believe the total addressable market of the memory chips will continue to expand. Even now, they are already at a relatively high level. And the current AI boom or this demand for the supply chain is not only benefiting or favoring the so-called memory chip industry, it rather creates an AI ecosystem, particularly benefiting the regional equities. For example, South Korea is a leader in terms of the memory chips, but Taiwan, also a global leader in terms of the semicon foundry and also the so-called OSAT, OSAT, the outsourced semicon assembly and testing process. Well, Japan, it sounds like Japan is irrelevant, but actually Japan is highly relevant because of its strength in terms of the high purity materials. And this kind of materials is very important when we're producing the AI upstream related equipments. So in the interest of time, we'll just highlight the South Korea because it is one of the best performing markets in the world year to date. How South Korea is a clear beneficiary from the current AI boom. And this is actually not surprising because even in the context of the global semicon supply chain, the South Korea is just below the US, acting as one of the key leading providers in terms of the revenue shares and also in terms of the R&D spending. And also by firms, as shown on the right-hand side. In fact, the Samsung and SK Hynix are actually the only two Asian firms among the world's top 5 semicon suppliers in terms of the chip revenue. So that's how I explain why Korea can have a leading edge. And these two tech leaders, they did help the South Korea become one of the best performing equity market year to date. Even considering the recent 1 month market volatility, they're still performing the best. And in addition to the tech-driven rally, we can also see that the shipbuilding sector, defensive sector, machinery sector, together with the corporate reform pushed by the Korean regulators, they also help stabilize the overall Korean equity market. But as shown on the right-hand side, it's worth noting that it seems starting from this year, the foreign investors became a net seller of the Korean equity markets. But don't worry too much, because instead of a more bearish view on the memory chip industry, this kind of reduction of the overweight is more of a reallocation or rebalancing consideration, because their previous exposure to single country, like South Korea, is already high. And it's also worth noting that although there is a sharp drop from the foreign investors, the domestic institutions and the domestic retail investors in Korea, they quickly fill this gap. So there's still a technical support for the Korean equity market. And also, the Korean equity market gets directly government support, and this support is beyond the industry support, because the president already mentioned this, but they also get the capital market reform support, such as to strengthen the minority shareholder rights against the chaebols, to eliminate the Korean discount. And don't never underestimate this kind of support, because these kind of reforms have already increased the minority shareholder participation and also the returns. This is reflected in the a surge in terms of the shareholder engagement or the acceleration of the share buyback activities, as well as the cancellation of the existing inventory shares. And all of these translate into a total shareholder return, which is at least higher than the domestic Korea bond yield. And for those investors who are already following the Korean equity market very closely, you may be aware that in the recent 1 month's time, the Korean equity market is highly volatile, up and down, due to the oversupply concern. And someone may attribute these, or at least partially attribute this, to these foreign net selling. But if you look at the chart on the right-hand side, from a cumulative net flow perspective, even starting from the second quarter of this year, the foreign flows to the Korean equity market is already stabilizing. And it's already at a very high, on the top of a very high foreign participation to the Korean market as well. So, of course, we all understand there are concerns on oversupply, there are concerns on the capex, the surge in the capex, there are even concerns on this intensifying competition within the industry. But just as I said, as long as the supply falls short of demand in the next 2 years, we still believe there is further potential of the underlying chip market. And more global brokers, they're also on board the Korean equities to make it available to global investors. But for Singapore investors, without such access, in fact, there are 2 ways. One way is through the ADR. For example, the Hynix ADR just listed in the US. But not all the tech leaders, they have an listed ADR vehicle available for the US. For example, the Samsung, they still don't have a listed ADR. And the other way is the ETF for sure, particularly for the ETF listed on the SGX, such as our CSOP APAC Select ETF with the US dollar counter LCU and the SGD counter LCS available on SGX, and also, of course, available on the fund supermarket. Also, if the retail investor participation is insufficient. Then now the Korean pension institutions, the NPS, their directly allocation to the Korean equity market, we do believe it's a clear trend of the capital being redirected towards the Korean domestic market and providing another meaningful tailwinds for the overall Korean equity market. And specific to key underlyings, I think everybody may be already quite familiar with these names. As the key suppliers to the NVIDIA, the SK Hynix has already grown into the world's largest memory chip maker by revenue. But despite the recent 2 years strong rally, its current year forward PE, based on the most recent data, because the data here on the slides are already outdated, is just 5 to 6 multiple. It looks like a value stock. Why? Why after strong rally, they still treat it cheap? This is because the earnings prospects, earnings outlook is very strong, much stronger than the price rally. That's why it's lead to a value-like stock, a PE. And also, as for the Samsung traditionally a Korean national stock and treated as a conglomerate because it has a leading position in terms of display, in terms of mobile communication, as well as the consumer electronics. But investors should also bear in mind that Samsung is also Asia's second largest semicon company and also have a leading edge in terms of the capacity expansion as well as the technological innovation. So, in order to capture a so-called AI boom using the APAC underlying regional equities without incurring too much risk, or let's say incurring too much concentration risk, we do believe the ETF is a good idea. And this page is a snapshot of our CSOP APAC Select ETF. On the right-hand side is product, on the left-hand side is the index. And it is interesting to note that the benchmark or the index was originally designed as a universe to include APAC large and mid caps with the low carbon characteristics. But after this low carbon screening, the high-tech leaders, the financial services leaders, and other blue chips, in fact, stand out. So to help investors to quickly or easily remember the product's counters and features, now the LCU and LCS are no longer simply representing the low-carbon counters, but rather representing the local chips or leading chips counters in terms of US dollar and in terms of Sing dollar. And also as an EIP product, for Singapore individual investors, it's quite easy for them to trade starting from 1 unit. And since inception in late 2022, the NAV per share for the ETF has already more than doubled from around $1 US per share to around $2.15 per share. And this page is a snapshot of the underlying breakdown. It shows that the underlying stocks have a broad coverage across the APAC region. For example, as shown on the left-hand side, in terms of the regional breakdown, the Japanese blue chips are leading the way, followed by the tech leaders in Taiwan and also in South Korea. And China and Australia also have some meaningful exposures, but China, the stocks is more of the Chinese stocks listed in Hong Kong, and Australia is mainly the Australian bank names. And as for the sector breakdown on the right-hand side, it's not surprising that now the technology sector account for the largest weight, followed by the financial services and also the consumer discretionary. I think this is important. Why? Suppose the AI boom is set to continue in the next 2 years, and together with a high for longer interest rate environment, then both the technology and financial services sectors will benefit from this trend. And CD, the consumer discretionary, the picture can be mixed, but the AI-driven wealth effect can provide some downside cushion. And if this demand for the AI supply chain continues, it may also benefit the upstream industries like the industrials, communication services, materials, or even the related property sectors. And as you can see on the left-hand side, since the beginning of the year 2025, this FTSE APAC Select Index has already significantly outperformed its major US and China Asia indices, thanks to this AI-driven rally. And by calendar year, as shown on the right-hand side, since the product launched in late 2022, for the first 2 calendar years, it was mainly featured by a broad-based recovery from the Japan equities. But in the most recent 2 years, it's more of a tech-driven rally. And this is a performance table of our ETF, as shown on the right-hand side. Since inception, even net of fees, it has delivered an annual 22.7% return. So cumulatively, this total return is already over 100%. And even year to date, or the first half performance, already exceeded 20%. But of course, for the recent 1 month return in June, we see some corrections. But once again, as long as the supply-demand gaps here, there's still some potential for the further upside for the ETF and also for the index. And this page is a snapshot of the top 20 holdings of the underlying index and the ETF. Again, to echo my previous point, the low carbon screening naturally translates to the high-tech overweight, as shown in the top 3 holdings here, TSMC, Samsung, and SK Hynix, which are also the global leaders in terms of the semicon supply chain. And others stocks mainly include the softwares and also some key blue chip financials. And financials mainly act as a stabilizer to the overall portfolio. So even one stock, they experience a large up and down, it will not impact the overall performance of this diversified portfolio. And the valuation also interesting. Even over the past 4 years, every year up, the index up more than 20%, 22%, but the valuation, the PE, it still looks fair versus its previous, like the dotted line, their previous historical 5-year average. And more importantly, as compared to his US peers, the S&P 500 and also NASDAQ 100, it still shows a very juicy or decent discount. So if we combine this relatively attractive valuation versus the still earnings resilience in the APAC equities, we do believe there are more potential for these APAC equities to grow in the future. And at last, I just want to reiterate that the CSOP APAC Select ETF, they offers the Singapore investors access to the regional equities riding on the global AI trend. And for example, Samsung leading the memory chips production, and Taiwan, they're leaders in terms of the semicon foundry, and Japan is actually acting as the upper stream of the upstream because of their strengths in terms of the high purity materials. So if you have any questions regarding the ETF or regarding the market, we have a booth outside this conference room. So please feel free to ask my colleagues. So that's pretty conclude my presentation for today. Thanks, everyone.